Let's now turn to the advisory and take a look at the tax proposals in the budget. We're joined by Roger Perrett from Freshwater Wealth. Roger, welcome back to you. Now, we were talking about the budget when you were in last. Now, this was prior to the release.
That's right, yeah.
We were speculating what was there. There were many leaks to the media. Now, most of those changes came to pass and then some.
Yeah.
What's your take out as far as the biggest changes are concerned, and I guess potentially how that affects investors?
Yeah, that's right. There's a lot of noise at the moment, do you know what I mean, whether the changes are good or bad. But the three main ones I think people really need to understand are one, the changes to the capital gains tax. The second is how it affects negative gearing. And the third thing is in terms of discretionary or family trusts. So they're the three big ones. So I think even more so, ownership structures for investments going forward is going to be super important for people.
Now, clearly there's been a lot of focus on the property market, the impact these changes, in particular capital gains and negative gearing, are going to have, given those discounts have essentially been withdrawn. But let's start with capital gains tax, because this actually applies to all assets.
That's right,
so,
yeah.
What do you see as the significance of the changes and how it will impact investors?
No, that's right, yeah. So the capital gains tax covers all asset classes. So maybe I'll just explain now. So the capital gains tax as it stands, if you basically have a gain on an asset for greater than 12 months, you get to discount that gain by 50% and you're taxed on that balance, if you like. From the 1st of July 2027, effectively any accrued gains from that time will be calculated using a different method. So again, it's the difference between the purchase and the sale price. But instead of 50%, I guess, adjustment, the adjustment is based on inflation per year. So I guess in the short term, the tax is going to be significantly higher for people because you may have to be paying 47% tax on a capital gain, whereas at the moment the max is 23.5%. However, over the long term, if you look over like 15 years, say 15 years and 3% inflation rate, you're probably looking at a similar discount level. So really long-term assets, like assets you're holding for 15 years, these changes actually may be better from a tax perspective if you can hold them for that period of time. But any sort of short-term assets, yeah, it's going to be a significant increase in capital gains tax.
We'll get to how potentially you can structure your investments, but are you saying most immediately there that perhaps it pays off then, obviously, to hold for longer?
Yeah, that's right. So the longer, the way you look at it, I think potentially the capital gains tax may actually be less, but short term it's worse. But just the way you choose investments may need to change as well. So like if you've got a really active portfolio and you're changing a lot, you could actually have a higher level of capital gains tax to pay. Whereas potentially assets in your own name, if you're investing in indexes and things like that with less turnover, you may have less capital gains tax if you're investing in those style assets.
Let's turn to negative gearing. So this is obviously you can claim on losses on an investment property.
Yes.
They're taking that away aside from new builds.
That's right, yeah.
How do you see it?
Yeah, so probably just to explain, so let's just say someone's income was this amount and they've got an investment which is geared or borrowed. You have to add on the income, whether it be rental income or dividends, but then the expenses, like interest, can then be deducted. So if the expenses end up lower than what your total current income is, that loss, if you like, you can claim as a tax deduction. So this is not for all assets. This is particularly just with existing residential property where there's a carve out. So you won't be able to negatively gear properties purchased in the future if they're existing, but you can for all other asset classes. So you can still negatively gear for shares, you can still negatively gear for commercial property, and indeed for new residential property, we can still gear in that case too.
Thirdly, discretionary trusts or family trusts. What's the impact there?
Yeah, so I think with family trusts, there's probably two main principles, if you like. So the first one in Australia, it's from a tax perspective, you pay less tax if, let's just say two people, like say a husband and wife, they're at a similar income level rather than having one person on a high income and one person on a lower income. So a discretionary trust provides asset protection, but it also allows people to even up, to spread the income around rather than having that scenario where one person's got a higher income compared to others. The challenge though with the new legislation going forward is that there's going to be a minimum tax of 30% on the income coming via these family trusts. So if people were using family trusts to, I guess, distribute income to like a non-working spouse, or say kids who are at university with low tax rates, well, that's not going to work so well anymore, because we've got a 30% minimum. So that's not going to work anymore. Whereas in the past you would have been able to use those tax-free thresholds. The other thing is with the family trust, they've really almost clamped out the bucket company strategy. So a lot of people with a family trust, they basically cap the tax on their earnings, passing it off to a company, and the company was now, a company tax was 30%. So in the past, the maximum tax rate via a family trust was almost 30%, but now there's a minimum of 30%, and going via a bucket company I would say, is going to be ruled out going forward. You really need to look at that if you use one, and consider a new strategy if these proposals are implemented.
So, strategies, you've just mentioned that, Roger. What potentially can you set up, assuming that these changes are legislated? And it's often been said since these changes were announced that perhaps investors will now move from growth to income, which sounds like a retiree strategy, essentially, doesn't it?
No, that's right. Yeah, so you can certainly look at the style of investment. I think the ownership is really, really important. So as I said, long-term assets in your own name are still okay. So that's okay. One of the big ones that didn't get touched was superannuation. So again, there's restrictions on when you can get money out of super, but in terms from a tax perspective, the tax on earnings within accumulation phase is only 15%, and in pension phase it's no tax. So definitely superannuation has unscathed out of this budget, and I'd definitely be looking at it from a tax perspective if it aligns with all the other goals and timelines for you. So superannuation definitely worthwhile considering. Companies worthwhile considering. It's good for income type assets, but there's no capital gains tax discount within companies. So there's, I guess, pros and cons considering companies. Investment bonds, similar tax rate after 10 years to a company. The beauty, or one of the beauties of an investment bond though, after 10 years when you take your money out, there's no top-up tax, whereas taking money out of a company there is, and that top-up tax could be like an additional 17%. So investment bonds after 10 years can be attractive as well. So they all come with their various nuances, so it's not sort of one obvious decision, but certainly there are a couple of things that people can consider.
Now, as I mentioned, yet to be legislated, but assuming they are more likely to take effect July 1 next year, nonetheless, do you need to act now?
Look, I don't think we can act now because the legislation hasn't been approved. Based on what I'm hearing, that it will be, but you never know. Like, it could get changed. So I wouldn't suggest people make any changes yet. But I do think people should really review their situation because when this comes in, the old strategy they may be using may not be beneficial anymore. So the special call-outs, if you're using a discretionary trust or a bucket company, via a discretionary trust, I really think that that's super important. But just if you're planning on negative gearing existing property or buying an existing property in the future, maybe you need to reconsider that. So not necessarily a no, but definitely I'd start reviewing your financial situation because of these proposed changes.